Most people don't lose money because they pick bad investments. They lose money because they chase high returns before they're emotionally and financially ready for the risk that comes with them. And that distinction matters more than most people realize. Because chasing returns too early doesn't just lead to temporary losses. It changes how you experience investing. And here's the part almost nobody talks about. Chasing high-return investments too early doesn't just slow down your progress. It can permanently damage how you think, how you feel, thus, and how you act as an investor. It conditions you to expect excitement instead of consistency, speed instead of patience, and big wins instead of steady progress. Today, I want to show you the hidden risk of chasing high returns too early, why it quietly leads to some of the biggest investing mistakes, and how a smarter approach to long-term investing actually builds more wealth with less stress, fewer regrets, and far better odds of success. If you want to avoid unnecessary financial risk, stop repeating common beginner investing mistakes, and build real, sustainable wealth, you're in the right place. Before we go any further, take 1 second and subscribe. This channel is about calm, realistic investing, not hype, not hustle culture, and not emotional decisions that feel exciting in the moment, but quietly derail your future. All right, let's break this down. Why high returns are so tempting. High returns promise speed. They promise shortcuts. They promise a way to catch up fast. For someone who feels behind, stressed, or uncertain about money, that promise is incredibly powerful. That's why high returns aren't just attractive financially. They're attractive emotionally. But investor psychology doesn't care about your long-term plan. It reacts to excitement, dramatic success stories, and fear of missing out. It focuses on what could happen, not what's likely to happen. This is where risk versus reward gets misunderstood. Higher potential returns almost always come with higher volatility. And volatility doesn't just affect numbers on a screen. It affects your sleep, your confidence, and your ability to stick with a plan when things stop going your way. The real risk isn't losing money. Most people think the biggest danger is losing money. It's not. The real danger is what happens after you lose money. Big swings early on teach your brain the wrong lesson. They create stress. They create doubt. They create a constant sense of second-guessing, and over time, they lead to emotional investing. You start jumping in and out of positions. You abandon plans during normal market cycles. You hesitate when you should stay steady, and act impulsively when you should pause. Eventually, you stop trusting the process entirely. That's how people sabotage their own wealth building, quietly, gradually, and without even realizing it's happening. Why capital preservation comes first. Early investing isn't about being aggressive. It's about staying in the game long enough for investing to actually work. That's why capital preservation matters more than flashy returns early on. When your portfolio is stable, something important happens. You build confidence. You build consistency. You develop discipline. Those traits matter far more than short-term performance. Without portfolio stability, even the best asset allocation falls apart under pressure. A plan that looks great on paper becomes impossible to follow when emotions take over. The goal early is simple. Build a system you can stick with when markets are boring and when they're stressful. Compounding requires survival. Compounding returns don't work if you quit. And most people don't quit because investing doesn't work. They quit because the emotional swings become unbearable. Chasing big wins early often leads to poor risk management, overexposure to volatility, panic selling at the worst moments, long recovery periods that drain confidence. Ironically, people who aim for realistic returns often end up far ahead of those chasing home runs, simply because they stay invested long enough for compounding to do its job. Quick pause. If this kind of calm, practical investing guidance is helpful, subscribe now. Everything here is focused on avoiding costly financial mistakes, building a strong wealth mindset, creating long-term financial independence without burnout. Let's continue. Why beginners get hit the hardest. If you're newer to investing, your biggest risk isn't lack of knowledge. It's lack of experience with loss. That's why investing for beginners should focus less on maximizing returns and more on building resilience. Early on, it's critical to learn how volatility actually feels, understand how markets behave over time, develop real patience in investing. One bad experience early was one sharp loss or emotional decision can push someone out of the market for years, sometimes forever. That's a heavy price to pay for chasing returns too soon. Risk management builds real wealth. Professional investors don't chase maximum upside. They focus on survivability. Strong risk management means accepting lower upside in exchange for consistency, protecting your ability to stay invested through downturns, avoiding decisions driven by fear, ego, or short-term pressure. That's how sustainable wealth is actually built. Quietly, steadily, and intentionally, without needing constant excitement. Risk vs. reward is about behavior. On paper, higher risk might look attractive. In real life, behavior matters more than math. If volatility causes you to lose sleep, check prices constantly, change strategies every few months, then the investment is too risky for you, regardless of its potential return. Emotional tolerance matters just as much as numbers. A better question to ask. Instead of asking, "What's the highest return I can get?" ask, "What strategy lets me stay invested for decades?" That single shift eliminates many financial mistakes to avoid. It turns investing from a game of excitement into a system of endurance, and endurance is what wins. Why get rich slow works. Get rich slow doesn't sound exciting, but it works. It respects human psychology, market uncertainty, real-life interruptions. Slow doesn't mean passive. It means intentional. It means choosing strategies that compound over time without breaking you emotionally along the way. Wealth is built quietly. Real wealth building rarely looks impressive year to year. It looks boring. It looks consistent. It looks uneventful. But that's exactly why it works. The people who succeed long-term aren't smarter. They're calmer. The hidden risk of chasing high returns too early isn't just losing money. It's losing confidence, losing discipline, and losing time you can't get back. Focus on capital preservation, portfolio stability, long-term investing, emotional control. Give compounding the one thing it needs most: time. If this video helped you rethink how investing really works, subscribe. This channel is here to help you avoid emotional investing, build sustainable wealth, make smarter decisions with less stress. Thanks for watching, and I'll see you in the next one.